Have you ever wondered if property development could be your next big wealth accelerator? You've probably heard the success stories of investors who turned modest sites into multi-million-dollar assets by building townhouses, maybe two townhouses or duplex. But what you don't often hear about the sleepless nights, the missteps, the cost overruns, and the unexpected council headaches, or the learning experiences that chew up your profits and time. So today I'm joined by my business partner, Greg Hankinson, Director of Metropole's Project Development Division. Now, Greg's had almost 3 decades of experience managing hundreds of successful small to medium scale developments. So welcome to another episode of the Michael Yardney podcast, where we help investors gain clarity amongst the confusion of all the mixed messages regarding our property market so they can develop the financial freedom they're looking for. Now, just to make things clear, what we're going to be discussing today isn't about becoming a full-time property developer. It's about how smart investors are adding a powerful strategy to their portfolio, one that's backed by professionals who've done it hundreds of times before. So whether you're looking to build your wealth faster, reduce your reliance on market growth, or just explore what's possible beyond buying and holding property, this episode's packed with insights that you're not going to want to miss. So let's get on with it.
Welcome to the Michael Yardney podcast, where twice each week you will learn a number of new ideas regarding success, property investment, and money in around 30 minutes. Our show is brought to you by Metropole, who specialise in helping you grow, protect, and pass on your wealth through strategic property and wealth advice. Now, here's your host, Michael Yardney, Australia's authority in wealth creation through property, who has been voted one of Australia's top 50 most influential thought leaders.
Most investors start out by buying a home or an apartment, hoping for capital growth over time. But what if there was a way to leapfrog years of growth and literally manufacture your own equity? That's exactly what small-scale property development offers. Building 2 townhouses on a single block. Look, it may not sound glamorous, but for many savvy investors, it's been a game changer, turning modest profits into powerful wealth accelerators. But here's the catch. It's also one of the fastest ways to lose money if you don't know what you're doing. So today, I'm joined by somebody who absolutely does know what he's doing. Greg Hankinson, Director of Metropole's Property Development Division. Greg's been guiding our clients through successful townhouse developments for over 20 years. And in this episode, we're going to pull back the curtain on how you could also get involved in and become a successful property developer. Welcome, Greg.
Hi, Michael. Nice to join you again.
Well, Greg, with some parts of our property market surging now that interest rates are falling and buyer confidence is coming back, others are slowing. But I know more and more investors are coming to Metropole asking about manufacturing capital growth. So why are townhouse developments, and in general what some people would call duplexes or just building 2 townhouses, why are they appealing at this stage of the property cycle?
Well, there's an incredibly low supply in the market of quality stock, particularly in established suburbs. So there's a huge demand. As we know, population growth is increasing. There's a surge of people coming into our capital cities, and there's an undersupply of good quality properties, and not everybody wants to live out in the greenfield estates and further away from the CBD. So there's a huge demand and undersupply of quality stock. Small developments like this also, we have much more control over profit and timing. It's different finance and different regulatory approvals required, and we have much more control over the making profits on these kind of developments.
Interestingly, Greg, we know that the governments and local councils are wanting more medium density developments. We know that the federal government's talking about 1.2 million dwellings to be finished before middle of 2029. We know that's not going to happen. And they're talking about more apartments and high-rise complexes, but also medium density developments. I actually see townhouses as being an increasingly preferred style of accommodation for young families and gentrifying families because it's modern big accommodation but on compact blocks. They're trading backyards, I guess, for amenity, for courtyards and ability to go out to the local park, but they like the inner middle ring suburbs. I've actually seen a lot of these townhouses being built in the outer suburbs, Greg. I don't think that's really what we're talking about as the right place to build this.
Well, I'm not sure we get the right sort of end values that justify the expense and the risk involved in those outer suburbs. The inner ring suburbs, those highly affluent areas, in a lot of ways, Michael, we're kind of breaking the mold in terms of what you would perceive as a traditional investment property. What we're talking about with development projects like these duplexes is they're designed for the owner-occupier market. So it's all about the end values and maximising the end values. And I'm not sure you get the best return in the outer rings.
Well, interestingly, while they are designed for owner-occupiers, clearly there are many affluent tenants who want to rent this sort of accommodation. Sometimes it's because of amenities, sometimes because of school zone, sometimes it's because of a divorce, or maybe they've moved to a new state. So people don't only rent because they can't afford to buy, do they?
Very much so. In fact, a lot of the projects that we're designing and building, these are 4-bedroom, 3-bathroom homes with multiple living zones and studies. They're a family-size home, and they're renting very, very quickly for sometimes in excess of $1,500 a week.
Now, I know that we're going to go through all about this in a moment, but we won't be able to cover everything involved in property development, what you've got to think about, what you've got to consider, and what you should avoid. So I know in July you're putting together with Brett Warren, Leanne Jobson and Lachlan Myrons one-day workshop in Sydney. So I'm going to leave a link in the show notes. Go to realestateworkshop.com.au where you can actually hear Greg and the other experts go through this in depth. I know you've done it in Brisbane a couple of months ago and in Melbourne last year, and people got great insights into it. For example, a moment ago you talked about more control. We haven't got time to go into all that, but in this particular session, but it also is easier to finance a 2-townhouse development as opposed to a 3 or 4, because the banks see it as a residential loan as opposed to a commercial loan. But while you can manufacture capital growth, in other words, you build it at the wholesale level, you get better rental returns because the tenants don't know that you've built it cheaper. The bank will refinance it at the end values, not what it cost you, so you can pull your money out and do it again. You get great depreciation. So there's lots of benefits in getting involved in this. Greg, boy, are there a lot of things that you can get wrong. What are some of the things successful investor developers do compared to those who get burned?
It's all about planning, preliminary planning. So getting your ducks in a row right from the very start. Poor planning equals poor performance.
Yep.
It's the fundamentals don't really change. So if you put the time and effort into getting all your ducks in a row in terms of purchase ownership structures, finance, I mean, we've said a bunch of times, property development is a game of finance with some houses thrown in the mix. All of these things have to be thought through and in place before you commit to proceeding with a development. So I guess the number one strategy is get your ducks in a row and make sure you've got a plan in place. It's a matter of having a system, isn't it, Michael? And having a plan, a very clear strategy on how to get in, how to get through, and how to get out the other end.
Well, let's talk about getting out at the other end, because I know a lot of people who initially approach us like the idea of, I'm going to do development, I'm going to sell it, and I'm going to flip it. Now, in the old days, there was margin in that, and that's what the average developer does. Unfortunately, today, the way building costs have increased and other costs have increased and compliance issues, it's actually not profitable to buy, pull down an old house, develop and sell. And that's exactly why you started off by saying there's not a lot of stock, but it's a really great way to buy your long-term investments at wholesale, isn't it?
Yeah, exactly right. I mean, wouldn't it be nice if when you and I started developing properties, if those margins were still there? The reality is they're
20%
not anymore.
margin. Yeah.
Oh, you wouldn't look at it if it was less than 20% margin. The reality is with, as you said, the construction costs have gone through the roof, depending on who you speak to, somewhere between 30 and 40% over the last couple of years. And end values, they vary in each state. Melbourne's been flat for a long time, as we know. Brisbane's been on a little bit of a run. But for the most part, the end values haven't kept up with construction costs.
Yeah.
So
Sure. It
the
will
outset is
eventually, but if you do the sums
sure.
at the moment, it is difficult. So I guess that's one of the other things I've seen where people get it wrong. They don't know how to do a feasibility. They actually look at the land cost and add the construction cost and add a little bit extra. And there's a whole lot of other costs along the way, including consultants and holding costs. They don't know what interest is tax deductible, and certain interest costs during the development process aren't. They don't realize that. And that's what we help our clients with, because we actually give, just if you're interested in getting involved in development, I'll leave a link in the show notes for that. Also, have a chat with Greg. I'm sure you won't mind, Greg, because you can show people a sample feasibility with all those extra costs. And there's a whole page of them, isn't there?
Yeah. Well, unless you've done it before, you don't really know what costs you're up for. I mean, people are funny. They've often convince themselves that they want to be property investors and property developers. So they'll manipulate the feasibility to get
Yes.
the outcome that they want, to convince themselves that they're right. And once they're committed, whether it's
Makes
right
it
or
very
wrong, it makes it very difficult to come back from.
It does. So, yes, you can almost make figures say anything you want. So, first of all, as you correctly say, get your ducks in a row. I think it's also important to understand where you are in the property cycle, because a development takes probably a number, at least 2 years, and it could even be longer. The first 12 months, you put a tenant in place in the old property that you buy while you get your development approvals and the plans and the costs, and eventually sign a building contract. And you get rent coming in for that first year, but not much, because you don't want to buy a particularly good property that you're going to pull down. The second year, there's no income coming in, so you've got to be able to finance all that. And then you hope that the development's going to come out at a comfortable stage in the property cycle. There's always unknowns, but even if you're wanting to hold it in the long term, you don't particularly want to end up at the downturn of the cycle. Fortunately, Greg, with interest rates falling a few more times this year, with the government with its big Australia policy, with lack of supply, I can see this is actually going to be a good time, because if you get in now, when you complete your development, values are likely to be significantly higher than they are today.
Yeah, I think so. I mean, knowing where you are in the property cycle is important. It's very important. But if we take a long-term view on property, where you are in the cycle is probably less important than if you were speculating, if you were
Yes,
designing
yes.
and building to sell. Then it's
That's how we
critical.
protect ourselves. You're 100% right, Greg, because if you want to sell, you're in trouble if it's the wrong stage of the cycle. If you're going to hold, doesn't matter. It'll never get cheaper, will it? The land will never get cheaper, and the construction cost will never get cheaper.
It'll never be cheaper to build. It'll never be cheaper to buy land. So if you're manufacturing that equity, where you are in the property cycle it's important. It's good to know and understand. In fact, it's critical to understand where you are. But in terms of the outcome, it shouldn't really change anything.
Well, one of the other mistakes I see people make is buy a property because the agent says it's got development potential. And in Victoria, they usually put STCA, subject to council approval. Anything with that after it, ignore anything that's in front of it. So when you look at a property that's got or for development potential, what do you look for?
We've got an extraordinary list of criteria. And in fact, we say no to so many properties that are supposedly developable. Sure, you might be able to develop it, but if you can't develop it and get the sort of return on investment that you expect, then it's not a suitable development site in my mind. So we do
It's
an
not
incredible
just
amount
the
of
zoning,
due
is
diligence.
it, Greg?
Sorry?
It's not just the zoning, is it?
Oh, it's not just zoning. No, there's all sorts of. You need to look at overshadowing, topography of the site. You need to look at the services and adjoining owners and overlooking and all sorts of governance and compliance issues with council. An incredible. I mean, I guess this talks to my first point in doing some of that due diligence and getting your ducks in a row. You really need to understand what the criteria is, who the end users are, and work out from there whether it's a development appropriate site or not.
Interestingly, trees are a big issue on sites. You think, oh, that's okay, that's a big tree, I'll just get rid of it. Is it as easy as that?
We've seen some incredible fines come through from council I mean, back when we first started, to be honest, in the
Yeah.
early
You didn't
90s,
ask anyone's permission.
we would just moonscape a site, irrelevant whether there was a 20-metre substantial tree. You could get away with it then. You can't these days. So often a site or a prospective development site with a big tree on it will get a hard no from us.
One of the other things you mentioned a moment ago is topography. Often sites have a fall to the side or to the rear. You can't usually tell easily when there's already an old house on it and there's grass and there's a garden, but it actually can add substantially to the costs if you've got to work with a substantial fall over a site.
Yeah, that's right. And I mean, it might be appropriate, it might be workable depending on the location and then values. I mean, a bit of fall on the land can create some interesting and really nice design, but it comes at a cost. And if there's no return for that additional expense, then a different site's probably more appropriate.
I think one of the other things, we hinted on it already, is when you start off, budget realistically. And there are two sorts of costs that people who haven't been involved in development wouldn't even understand the terms: soft costs and hard costs, because the bank will lend you against some and not at others. And I know in the upcoming Ultimate Real Estate Development Workshop that you're running in Sydney on the 19th of July, you go through all of those, because if you think, hey, I can borrow from the bank against this and this, and you can't, it really just means you need a little bit more money. But I think the big thing people forget is the contingencies. They don't allow for those. Something always goes wrong.
It's inevitable. Something will always go wrong. And contingencies should be in line with your experience level.
Yes.
The less experience you have, the less, if you haven't done it before, you have to allow for a higher contingency rate. I've done over 500 development projects, so I work on a relatively low contingency, but I still put it in there. It's cheap insurance. I don't have to use it, but it's there in case there's something unforeseen that comes up.
Well, I know that you run the development project division for the team at Metropole, and when clients find site issues, maybe there's got to be more concrete. Most of the issues are under the ground. Maybe you've got to put more concrete. Maybe you found a sewer line in the middle, or old pipes, so you wouldn't find a new sewer line. And our clients find out about it. We say, hey, we told you there was a contingency allowed. We didn't know what it is. Hey, this is it. This is what we put them
and this is
allowance in for.
Often
and they feel comfortable.
That's right. It's often things around, pools, for example, that might have been buried, or asbestos that wouldn't otherwise have been detected prior to demolition, for example.
Now, I know you've got a vested interest, and people are going to say, oh, you're biased, but I guess you'd say that it's important to have the right team around you. Who should be part of your team?
Well, who should be part of your team? A bunch of industry experts that have done it before and either paid the learning fee already so that you don't have to. I mean, it comes at a cost. We're not talking about chicken feed. I mean, doing a development project like what we're talking about is expensive. We're talking about big dollars. So unless you've got a team of experts that know the outcomes, the property investors themselves have done it, know the setbacks and the hurdles and the red tape and bureaucracy that the hurdles you have to jump through and understand, then you're more likely to not get a favourable outcome. So it's critical to have the right finance team around you, the right tax advice around purchase entities, the right builder for your project, the right designers that specialise in duplex developments, and the right property manager all the way through.
I think the other thought is that be realistic with how long it's going to take, Greg, because it always seems to take a bit longer than you'd like.
Yeah, that's right. I mean, there's some unknowns. What we try and do at Metropole is not push the boundaries too far in terms of the planning design process. So we know what works in particular areas. We know what councils are looking for. What we don't want is to be caught up in VCAT, for example, and argue about whether the bedroom should be this size or whether there should be a window here or there. What we want is appropriate approval within the time frame that we expect. So timing is critical on these jobs.
One of the things I learned early in the piece when I started doing developments many years ago was to document everything, because everyone starts off with the best intentions, but it actually can avoid disputes or minimize disputes.
Well, it doesn't go wrong until it goes wrong.
Yes, well said.
Yeah. and when it goes wrong, it generally goes wrong pretty badly. And it always goes wrong if it's going to at the end of a project, when you're at your maximum borrowing capacity and your outlay every month is extraordinary, when the project's nearly complete and the builders, wanting their final payment. So unless things are documented, unless you follow the contract, and I guess this is where you have the right team around you as well, the right legal advice, the right contracts in place to look after your interest. It comes down to relationships for me at the end of the day. And if you've got a good relationship with your project manager, with your building company, with your design team, you're more likely to get a good outcome.
Now, one of the things that I've noticed when people come along and want us to help them become property developers is they already have in mind what they would like the apartment, the building, the townhouse to look like. They're designing it for something that they like. But I think it's really important to design it to the suburbs demographics. And in fact, what we design in Brisbane is very different to how it would look in Melbourne. If you put the Brisbane Hampton-style townhouses in Melbourne, they probably wouldn't be as appropriate, attractive, and similarly, even the materials we use in Melbourne are not appropriate in another state.
Yeah, I guess that's one of Metropole's point of differences in a lot of ways, is that we'll design something that's area appropriate and focused on maximising your returns. So we're not interested in making the cover of Bell magazine for amazing design and finishes. It's about how do we get an appropriate design with the right finishes that are going to maximise the return for you, the client, and get the maximum rental return. So there's two things: market value of the property and the yield of the property. And how do we finish those and design our duplexes in order to hit those marks? And we don't deviate from that.
Sure. Well, that's come after many, many years of experience. Now, of course, if you want to accelerate your learning and avoid some of these expensive mistakes, why not join Greg, Brett Warren, Leanne Jobson and Lachlan Myrams at our upcoming workshop in Sydney on July 19th. I will leave a link in the show notes, but go to realestateworkshop.com.au, find out the details and go along. And in fact, I know, Greg, you've put together a very detailed A to Z manual of property development that everybody's going to get there, that goes into a lot more detail about all of this.
Yeah, we'll go into a lot more detail around the preliminary works, the due diligence, the property market, the economy, how to identify a development site, and some of that due diligence around that, around the planning schemes and design guides. Lachlan's going to go into a lot of detail around finance for the acquisition and for the construction phases and some of the options around that. And Leanne's obviously going to go into a bunch of detail around property management post-completion.
Well, I know you're going to go through some of the common mistakes at the property development workshop, and we don't have time to cover them all here, but maybe we could go through two or three of the big ones so that our listeners, our viewers should know what they should avoid.
Yeah, I mean, the big one is misunderstanding development finance. Development finance is not like financing your home. There's a bunch of different lenders and different stages and funding needs. So Lachlan will go through the requirements. I mean, property finance and development finance is changing, Michael, on a weekly basis. And so unless you're up to speed with those changes and the requirements around that, then you're behind the eight ball from the start. So understanding development finance is critical to successful outcome.
So, Greg, finance is critical, as you've said. What other big errors, mistakes, lack of knowledge that beginning developers have?
I think it's understanding the soft costs, Michael. So there's expenses that can be financed, and there's other expenses that can't be financed. So you've got to come up with those costs from either a line of credit or cash or whatever means. Those are things like the town planning, the design expenses, architectural fees, some of those preliminary works. Unless you can cover these costs, then you're not going to get through the project.
Another reason to start with a realistic, accurate budget to know what the costs are when they come, because they come over a period of time. Some are happening during the planning phase. Others happen during the construction phase and others at the end as well. I think
it comes back to having a strategy right from the start and having a very clear plan.
Yeah. I guess another big mistake is the concept we've already discussed, the idea that maybe you should develop to sell.
It was, I'm not going to say a mistake, but it's what I did for the first 12 years developing.
So did I.
Yeah. I mean, I developed a bunch of properties and projects and sold almost all of them. Knowing what I know now, I would have been better to do half the amount of projects or less even and held them long term, and I'd be in a very different financial position.
So it's really a way of building your asset base rather than being a cash flow business. The idea of being a property developer and making cash and making a living out of it really needs very, very deep pockets. And even the most successful developers are just not even making profit at the moment. But if you treat property development as an asset growth business, it's a great way of doing it. And you can put protections around yourself to minimize the risk, Greg.
Yeah, the alternative is speculation, isn't it? And that's where property market comes into play. It's easy to make money on a rising market, but as we know, property is cyclical, and after an upturn, there's a downturn, and it just doesn't stack up in the long term.
Well, Greg, as I started to say right at the beginning of this, we're seeing a growing interest from clients and potential clients wanting help with small townhouse developments. So what do your end-to-end services, our end-to-end services at Metropole, actually offer them?
So we offer a turnkey development roadmap effectively. So we can manage the initial acquisition, sourcing of a development site. In fact, a step before that is we'll put a strategy together for our clients to get them
Yes.
the outcomes that they want. If that's a development site, we would go through the due diligence, the sourcing of a site, through the concept and design phase, the feasibility phase, to ensure that you get the right outcome and return on investment. We then offer the construction phase and move into the property management and holding that investment over the long term. So effectively, it's a turnkey design and build product for property investors.
Well, it's not just about building townhouses, as we said. It's really just a method of building your wealth through smart, risk-managed development. So if you want to find out more about this, I'll leave a link in the show notes and go to metropole.com.au, and you can have a chat with one of our wealth strategists. And as Greg said, it all starts by putting a plan together for you, a strategic plan, because it may not suit you at this stage of your cycle, of your journey. Of course, there's other people who already have a property, Greg, and in Melbourne and Brisbane, we can help them with assessing the developability of their property, Greg.
It's a big part of what we do. A lot of our clients have purchased property, particularly in Brisbane, where they've held property for a long time. The property market's moved, they've built some equity, and now it can be a suitable development site. So we do a lot of that due diligence and feasibility assessment.
So if today's episode sparked your interest in small-scale development and you want to do it safely and properly, I'd strongly recommend you have a complimentary chat with the team at Metropole. Of course, if you want to accelerate your learning and avoid the expensive mistakes, join Greg, Brett Warren, Leanne Jobson and Lachlan Myrams at our upcoming workshop in Sydney on July 19th, the Ultimate Property Development Workshop. Go to realestateworkshop.com.au. As I've said a couple of times, I'll leave a link in the show notes and you can get all the details. Thanks again, Greg. As always, it was fun.
Thanks, Michael. Been a good chat.
As a way of introducing a bit of fun in these podcasts, I'm now each week having a property trivia question where I give you, my listeners and viewers, an opportunity to win a hard copy of one of my best-selling books, How to Grow a Multimillion-Dollar Property Portfolio. So I'm going to ask you a question in a moment and just go to propertytrivia.com.au and enter your answer. And each week, 3 correct answers will win a hard copy of one of my books. And everyone will actually get a new updated report. But don't worry if you're listening to a slightly older episode, we're still going to count your entry. So here's this week's question. What was the everyday building material that saw huge price increases after COVID, causing huge delays, budget blowouts for developers and builders? Go to propertytrivia.com.au, leave us your answer, and you might win one of my books, and everyone wins or gets a copy of one of my new updated reports.
Now here's Michael's mindset message. Remember, a change in your thinking will lead to a change in your life.
My mindset message for you today is about questioning your self-worth. I guess what I'm asking you is, are you choosing to see your full worth? Here's a simple story that I find very interesting. A professor stood in front of his class, held up a crisp $100 note and asked, "How much is this worth?" And the class replied in unison, $100. The professor then crumpled it up into a ball, held it in the palm of his hand and asked, "How much is it worth?" And $100 is what the students replied. Then the professor threw the $100 note on the ground, stomped on it, jumped on top of it and asked, "How much is it worth now?" And looking confused at the professor's actions, the students shrugged and answered, $100. The professor smiled and said, "Good. Remember this lesson in your own life. Whatever happens, however people treat you, whatever circumstances befall you, your value remains the same." I guess the message is there are going to be moments where life stomps on you, where the storms hit and threatens to tear you apart. But in these moments, you've got an important choice. You get to choose to see your full worth. You get to choose to treat yourself with compassion, with grace, and with respect. You get to choose to remove yourself from the environment or the relationships where that worth isn't being appreciated. You get to choose to always appreciate your full value. You get to choose to see yourself as a $100 bill, unbroken by the storms in life. So my mindset message for you today is listen to this and choose yourself, your own self-worth. It's actually one of the most important choices you're going to make in life. So choose wisely. Thank you for spending the last little while with me. I hope you got some benefit from this show. But before you move on to the next podcast you're going to listen to, let me remind you I have another show that I produce once a week with leading demographer Simon Kirstenmacher. We call that Demographics Decoded, where Simon and I unveil the trends that are going to shape your future. In my mind, this is a must-listen-to podcast for anyone interested in property investment, but also for business people and entrepreneurs. So if you don't currently subscribe to Demographics Decoded, just please stop for a second and subscribe on your podcast app where you're listening to this, or on YouTube. And of course, if you don't subscribe to this show, the Michael Yardney Podcast, why not click the link that says follow or subscribe wherever you're listening right now. So twice a week, you're going to get benefit from my guests and me. And I'd like to ask you a little favour, please. If you did enjoy today's show and you know somebody who would also benefit, please tell them about the Michael Yardney Podcast and Demographics Decoded. There's a share button on every podcast app. On Apple Podcasts, there are 3 little buttons at the top of the player. Or just tell them about it. Just have a chat with them. Now, I hope you're going to be doing them a favour. And you're definitely going to be doing me a favour in my quest to help as many people as possible to become financially literate. And by the way, I've got a special bonus for you. As my way of saying thank you for subscribing, just go to podcastbonus.com.au. There'll be a link in the show notes, podcastbonus.com.au, where I've got a bunch of ebooks and reports. It's just my way of saying thank you for taking the time to listen. And remember, the information that we give you in this podcast is general information, not specific information about your personal circumstances, because we don't know about them. But if you do want specific information, you can always have a chat with my team at Metropole. Go to metropole.com.au. If you really want to learn more, you can always listen to the previous podcast, the many episodes we've already published. Just go back to the old episodes, which each have lessons about property investment, success, and money. Once again, thanks for listening to today's show.
Thanks for listening to this episode of the Michael Yardney Podcast, which was brought to you by Metropole, who help their clients grow, protect, and pass on their wealth through strategic property and wealth advice. If you like what you heard and don't already subscribe, you'll find us on iTunes or on your favorite Android app as the Michael Yardney Podcast. Watch out for our next show, which comes to you twice a week, and you'll learn some new ideas about property investment, success, and money in around 30 minutes. To get more of Michael's thoughts, go across to www.propertyupdate.com.au and sign up for his daily morning briefing, and you'll hear from not only Michael, but a group of leading property success and money experts. And just a reminder that the information you heard in this show today is general educational advice and not specific investment advice, as we don't know your personal circumstances. If you're looking for specific advice, why not ask the team at Metropole to help you?